Hello everyone, how's it going? In this video, we're going to cover Bed Bath & Beyond, trading under the ticker symbol BBBY. The market has been very volatile as of late, with many titles having huge up and down swings, and the volatility of BBBY may be able to provide gains or losses for people who want to test their luck. So in this video, we will take a look at the stock from a technical and the fundamental perspectives, and to determine what could be a recommended action plan to carry out for BBBY. If you appreciate my content, please consider to drop a like, comment, and subscribe to my channel. Also, please check out the links in the description section, as every help is greatly appreciated. Recently, BBBY stock price has reached around $2.61, down by about 15% on one day. Over the past 5 days, it went down by about 24%, but if we look at the whole month, it's down by more than 60%. So right now, I think that the stock is trying to reach some sort of floor around the $2.50 level, and they want to see if the price can remain there. So the bulls have now taken a pause on the stock, and they want to see whether the volume will pick back up or the looming solvency issue can be resolved. So these are not easy matters to resolve, and of course I would reasonably believe that at some point BBBY has to go out and finish off with their own situation about like bankruptcy once and for all. One of the potential solutions could be to sell their shares, but that, of course, has already been the case once before, so I'm really not convinced that this time they will reuse this technique, especially when the stock is nosediving. Regarding the bankruptcy issue, my understanding is that it's under discussion, that they are still trying to restructure their debt and to eventually have a cash injection, either by issuing new debt or by equity. So regarding the other thing, whether you should be buying BBBY, I would say that this is a small cap with a very high risk profile, so we obviously expect high rewards that come along. Personally, I believe that the fundamentals will have a double-edged effect. They will either have absolutely no effect. In other words, as long as the company doesn't announce anything regarding bankruptcy, it's not going to be modified or affected because the fundamentals are good or bad. Of course, if it's bad, then it's going to continue to grind downward. But if it's good, if they have a good quarter selling soaps and linens, this is not going to change much. On the other hand, if they ever say anything regarding the fact that they might go Chapter 11 or even worse, Chapter 7, then the stock immediately nosedives maybe to zero. So it's worth noticing that not everyone would necessarily dump the stock as long as the company isn't immediately liquidated. So if they go with a bankruptcy of Chapter 11, meaning reorg, then it's possible that the title will remain around, and given enough time, they may climb back. Painstakingly so, maybe, but still be able to climb back somewhat. So Bed Bath & Beyond, BBBY, is a home goods retailer. It was founded in 1971 and headquartered in New Jersey. It has shops in the United States, Canada, and Mexico. So the company has a wide range of products for home, including bed, bath towels, kitchen electrics, cookware, window treatments, and so on. They have a lot of home decor, giftware, and housewares as well. It operates both physical stores and e-commerce platforms, giving customers a wide range of options to shop in their stores. One of the key strengths of BBBY is its strong brand recognition. So the company has a decent reputation for offering a wide selection of high-quality products, and this over the years has definitely attracted a loyal customer base. The brand recognition also helps the company to successfully expand into new markets. So far we've talked about Canada and Mexico. One day maybe we can talk about Europe or Latin America as well. Another strength of the company is its diversified business model. So, in addition to the core retail businesses, it also operates the brands and businesses like Christmas Tree Shops, Harmon, BBBY BBBY, and One Kings Lane. So, these diversifications can also help, at least on paper, help the company to mitigate the risks and to generate stable revenue streams. Now, BBBY has been successful in developing strong relationships with suppliers as well, with timely payments and maintaining those relationships over years of collaboration. In recent years, though, the company has been facing some rough challenges, especially in the face of increasing competition from e-commerce giants like Amazon. Not that they don't also partially benefit from it, but what I'm trying to say is their competitors are legion, and the consumers for those kinds of goods are limited, especially in times of recessions. Additionally, the company has struggled with declining foot traffic at its physical stores, leading to falling sales and earnings. So, to address those challenges, they have tried to focus on the e-commerce side of the business. They've been working to improve the websites and mobile apps, making them more user-friendly and personalized. They're also focusing on store closures and cost-cutting measures. The company has closed down many underperforming stores over time and also laid off a certain number of its workforce, closing down distribution centers and consolidating the supply chains. So those measures are designed to help controlling the cost, therefore increasing the net income. With that being said, it still remains under significant sell-off pressure due to company-specific and macroeconomic factors. So the main reason why people might be interested in the stock to begin with might be the stock market price action rather than the fundamentals. And I would like to comment on this. Basically, this is another one of those, the company might not be doing so well, and there are structural reasons for it, right? Especially in this case, it kind of reminds me of GameStop. So GameStop is a company that sells games in the retail world physically. Now, this screams red flags. So it's the same case here. If we're talking about soaps and bath products, these are the kind of stuff that people don't need to, to go outside of their door in order to buy them. So having a lot of stores is kind of a weakness at this point, especially when people are kind of used to get things delivered at their doorsteps. I'm not saying that BBBY are not making efforts in that sense, but there are heavy trends that are not in their favor. So really, it's one thing for them to make the effort. It's another thing whether they're going to succeed. And it's even another thing, so like a third thing, about whether people can find BBBY attractive. It could be because the company has a very high short squeeze potential. It could be because people think that, well, volatility will create additional volatility. So therefore, in other words, if the stock has fallen by like 95% in a day, you know that there will be mechanical recoveries the next day or over the next few weeks. So in this case, I believe that this is what a lot of people are hoping for. They're hoping for this kind of non-fundamental price movement in their favor, meaning up. So with that being said, let's also talk about its ownership. More than 40% of BBBY's equity is owned by institutional shareholders, the rest being owned by retail traders. What this means is that while the stock has a relatively high volatility and is also a potential stock to invest in for the long term, theoretically speaking, in this case though, because of the going concern issue, I wouldn't really put the emphasis on investing just yet. So one key behavioral difference between institutional and retail shareholders is their investment horizon. The former has a far longer view on things, with a focus on a company's fundamentals and the growth prospects. They're also less likely to engage in short-term trading and less affected by those volatilities. Retail, on the other hand, tend to focus more on short-term gains and more likely to make decisions on a whim. In this case, because 60% of the shareholders are retail, what this also tells me is that it's going to be a volatile stock. And people are going to buy the stock or sell the stock on a whim. We want this for our trading scenarios, but I wouldn't say that this is necessarily great for people who want to put the money in the long term. In fact, don't put your money in BBBY for the long term because there might not be a long term. I'm not sure if this company has a guaranteed going concern. So in this context, I would not recommend to invest in the stock, but to mainly consider the stock for its trading opportunities. One of the key catalysts that might explain the retail interest in BBBY is also, like I've mentioned before, the short squeeze potential. Due to significant short positions against it, there are currently around 73 million shares being shorted off exchange, representing 55% of the short volume. This can support the theory that there is a concerted shorting operation from institutional short sellers against BBBY because of the fundamentals mostly supporting this outlook. I consider that the short position size can be significant and that this can indeed play a major role in sending BBBY's price action to a much higher level. The takeoff would be unrelated to the company's fundamentals but simply due to a supply and demand game. It also tends to be a self-fulfilling prophecy once buyers pile in. Now, it's also important to note that the short interest is not a guarantee of a short squeeze, but it's a metric worth monitoring for investors. It's also worth wondering that the short sellers may have valid reasons for their bearish sentiment, and a short squeeze may not happen. So my recommendation is to first look at if you are the kind of traders who want to buy a stock with a very high risk profile. Personally, it's a little bit too risky for me. But if you're comfortable with this kind of risk profile, then I would highly suggest you to buy now, but to keep in mind of the potential like a bankruptcy issue. So obviously with a position like this, it's better for you to control the exposure within 1% of the portfolio.